Hey everybody, welcome back to the Maddox podcast. This is season 2, episode 2, and you'll notice we're missing one key member here. This is Ladies' Day over here at the Maddox podcast.
We are the view.
Jason Maddox is just going to watch us from the corner while we handle the business like we always do. Today, I'd like to introduce two special guests. First and foremost, I'm going to start with our newest agent, Cindy, who is here. Cindy, on 2 legs today.
Yes, I made it.
How's your leg doing?
Leg is great. Maybe a future podcast is hidden dangers around the house. You know, so.
Yeah, that would be a good one.
Yeah.
Well, thank you for being with us today. We're so excited to welcome you to the Maddox podcast, give you a little taste of what we do here. And our second guest is going to be our star today. This is Carrie Pond with, I think it's Homebridge.
It is Homebridge.
We're Homebridge,
for the next 3 weeks.
For the next 3 weeks, we're still Homebridge, and maybe we'll get into a little bit of that. But we're very excited to have Carrie here. Carrie is a very valuable resource to us as agents. I call her multiple times a week. She's probably sick and tired of hearing me, but I'm always calling, trying to get updates on the market because I know she has them. And she's here to talk to us about a very special program today, which is the California Dream for All, yada, yada, yada. It has a longer title than that, but it's basically an equity share program that we were talking about last week on the podcast. And she's going to explain to us basically how in this market, well, let me start you off with a question. Mm-hmm. In this market, there's so much uncertainty. What is your advice to buyers? How is this program going to change the way we do things? What do you foresee it, do you see it increasing the market, increasing the activity in the market? What are your thoughts?
Well, and this is just my personal opinion.
Which is usually always pretty
great.
Well,
yeah. So, I mean, if you look at the California market in the broad sense, I think down payment assistance, because it's truly a down payment assistance mechanism to allow first-time home buyers to purchase a home. So the down payment assistance prior to this program has been relatively hasn't helped enough because the prices have gone up dramatically in the last decade essentially. So they passed, this all went through Congress. They passed a funding for this Dream for All fund. Originally it was $1 billion, but state budget. Now they've secured $330 million. So that's going to sustain some length of time. Hopefully it lasts. It should be at least a year. But what they decided when they did all their research was the barrier for entry for the average California first-time home buyer is not necessarily income, and it's not really credit. It's basically, the down payment. So to be able to offer 20%, not 10%, not 5%, but to be able to offer 20% in down payment assistance is a significant benefit to those first-time home buyers who have a hard time saving in this economy, in this, with the cost of living in California.
Absolutely.
So yeah, 20% is a significant amount. It lowers their payment because it avoids mortgage insurance, and they're borrowing less.
Elaborate on that a little bit for anybody who's just getting into this and doesn't understand. I think a lot of buyers have the misconception that you need 20% in order to purchase a home these days. And we've busted that myth many times. You don't need 20%.
Correct.
But if you do have 20%, where do the advantages come in? What do you gain from that?
So if you have 20% in addition to the 20%?
No, if you just have 20% down, you get rid of PMI.
Right. In any capacity, like whether you have gift from family or you have your own money saved or you use the down payment assistance. So, I have buyers that had previously been looking at $800, and the $800,000 home that they were buying with 5% down puts basically their their loan that they're getting $760. Well, with 20% instead of 5%, that $800 goes to $9, and it opens up just more opportunity for them for the same payment.
Yeah.
And even a lower payment because then again they avoid the mortgage insurance. So their 5% teamed with the 20 really does get them to that next echelon of home, but it also can get people into that first condo at $400 because you buy at $4, you get $80,000, then you're only borrowing $320, and that's a more affordable payment. So it gets more people in the market, which should help the broader market because more sellers will be willing to sell if they get the price that they want.
Exactly.
So if there's more buyers to buy the homes, there are plenty of buyers, but we also need to entice the sellers, which I think price would do that.
Yeah. And I think that taking a step back from that, it's really the first step of the home buying process. So oftentimes I'll have somebody who's interested in buying, and they want to start looking at properties, and they want to start looking at properties right away, and that's great. And in the past, I was like, yeah, let's just go see everything, and they would fall in love with a home, and then they're like, okay, now what do we do? And so really what I've learned through this whole process is lending is really the first step, right? It's contacting the lender to say, you know, what kind of programs are out there? And we're going to go deeper into the California Dream program, but what kind of programs are out there? Do I need the 20%? What does that look like? And so the buyer's then now able to find, you know, kind of go, okay, this is our max. We don't necessarily have to go to our max, but now we know what homes we're looking for. Do we have to look at condos? Can we go up to a single family? So finding that lender, Carrie, is the great first step in saying, what are the options? What are the programs available? And then having, you know, working with the realtor to go out and then, and then kind of house hunt, if you will, within those parameters of the budget. And knowing, okay, we want 20% down, and we can go into that and what that looks like, and then the California Dream program. But just for home buyers out there, securing that lender, knowing what the programs are, is really the first step in understanding, all of the nuances of each aspect. And we're going to go through, what those are, but just to kind of,
Well, you guys made some good points, and it actually drew something to my mind. So in the past, with rising interest rates, I've had a lot of buyers that, we hear it all the time. Unfortunately, their qualifications and basically their max approval price has gone down because the interest rates are raising. So with this, now they have 20% down. Are you seeing buyers going to be able to qualify for more than they maybe did, in the past few months?
Absolutely.
Yeah. So I think that's a very important point to make, because a lot of buyers have been hanging on the sidelines, getting very discouraged by the fact that their qualification, was maybe $800 last year, and now it's $750 or $700 because of the rising interest rates.
Right, because we qualify at the rate. Now there's still a temporary buy down available with this program too. Virtually any 30-year fix, I shouldn't say any, but this program, CalHAFA, it's a 30-year fixed conventional loan. You can do a temporary buy down on the California Dream for All first loan. So it's structured with a first loan offered by CalHAFA, California Housing Finance Agency, and then a shared appreciation second loan of 20% for down payment assistance and or closing costs. So you really could allocate 15 or 16% for down payment and 4% in closing costs, and so you really don't need to have any money saved. You do need to have your earnest money deposit when you that's the only thing, but that could be a gift, and it could be refunded at the closing table. And
earnest money, for anybody who doesn't know, is basically your good faith deposit that you wire into escrow within the first 3 days of getting into contract. We can elaborate a little bit on this too. It's usually 3%. Standard is 3%, and we try to hold to that. It's pretty customary in the industry. And what that does is that basically, does anybody else want to explain this?
I'm happy to.
Yeah,
so,
Katrina's good at
so
this.
in fact, I just met with clients who they're waiting for the Dream program to begin. And I said, okay, we don't want to get out there too soon because you're going to fall in love with a home, and then it's going to go off market, and then you're going to be like, so I said, this is kind of like shopping with your wallet. We have our wallet now, let's go shopping. And so they're just anxious and ready. And so when we were talking about the earnest money deposit, right, we have the 20% with this amazing program that's getting buyers in homes, that will get buyers in homes. But one of the things I discuss with them is that 3% earnest money deposit. When you make an offer, you have to offer some cash. So it's money that's coming from your personal bank to the title company, right? So it's not coming to me, it's not going to the seller, it is safe with the title company. But it shows that the buyer has some, what I call skin in the game. Are you serious enough that you're gonna transfer 3% of your money from your account to title to continue to show that you are in it to win it, so to speak? You are willing to move forward with this process.
Feels like an ante.
Yeah, right.
I'm in it.
I'm in it to win it. Here's some money, here's some proof. So we call that the earnest money deposit. Now when I receive, if I'm representing a seller and I receive something less than 3%, I go, is this buyer very serious that they're only offering 1 or maybe 2% of the earnest money deposit, when customarily it's 3%. So I discuss with my clients, while you have this program, we're still going to need to show our skin in the game. We're still going to need to show that we have 3%. And not just 3 days. Sometimes in offers, it's coming down to 48 hours. They want that money. They don't want you to wait 3 days to do it. Sometimes it's 24 to 48 hours.
Yeah.
And that's all, within the purchase contract. So we discussed where that money would come from. They're actually transferring that money with your approval, because like I said, we don't want to do anything without Carrie giving us, that green light that we're able to move forward. So if you're able to take the 3% from, whatever fund that you have, let's make sure we get the green light on it. They have it ready. So as soon as they're ready to make an offer, it's ready to go and they can transfer that. And I said, let's prepare for 48 hours because that's kind of what's customary here in our market is, up to 3 days and 3%.
Well, and it depends on the day you're getting into contract too, right? If you're
it depends on the competition level too.
Competition,
because one of the phone calls I took on my way here was a buyer who just ratified on a contract, but she's selling in the Bay Area and moving up, to the foothills. And so that deposit was 1%. And, they were selling their house and she's like, we spent a lot of money to fix it up and my husband gets paid on Friday and, it's due on Friday. And I'm like, don't worry. So she asked me, well, where could she pull the funds from? And I told her, and it's fine. But that was a 1% deposit.
Exactly.
So
every area is going to have their own, what they determine is kind of customary and standard.
And it's also called a good faith estimate. It's like your good faith that you're going to follow through with the purchase on the contract that you
exactly. And our job as agents is to make sure that your money is never at risk. So yes, you're wiring that money into escrow, but then we have contingencies in place. And we have a timeline that we need to follow to remove those said contingencies. And if you back out for any reason that is not, or that is justifiable within those contingency periods, your money comes right back to you.
Exactly.
We're going to put you in a position to where you are not.
I always say, I'm not going to throw you out of the airplane without a parachute.
Yeah, right. Exactly.
You're safe. You're safe. Your money's safe.
Yeah,
and there's other exceptions to the rules too. Sometimes if I have a client that is maybe using an FHA loan, which is 3.5% down. 3.5% down is their entire down payment. They don't have a ton of, room to risk the full 3% right away. So there are exceptions to the rules, but in a very competitive Bay Area market, which we often experience, we do try to hold to that 3%, especially when you are putting something like 15, 20% down. It's obviously a lot less than your entire down payment.
Exactly.
So I'd love to circle back for a minute and just ask Carrie a question. So in talking about this California Dream for All program, I read a little bit about it, and what I was reading was that not all lenders offer it. So it's very important to pick a lender that is knowledgeable about the different products in the market for loans and things. Is that correct?
Correct. I mean, if you go to the CalHAFA website, it will tell you what lenders are and are not approved. And they're very much they're very supportive. California Housing Finance Agency is very supportive to their lenders, and they've got select loan officers that they will give because they get an influx of buyers, and they direct them towards their preferred loan officers, which, I am on a team with, we're preferred also with CalHAFA. Also approved lender, but a preferred loan officer. So we work well with California Housing Finance Agency, but just in general, the program, 20% is such a significant amount that it's really going to help not only buyers, but sellers, because there's going to be, I'm going to be more willing to pay a little more. And this is maybe an advance. So just stop me if I get, but even if I put down 20% and maybe I'm not sure that the property is going to appraise, I have 20%. So if it doesn't appraise, I get a little less assistance, but the deal will not implode because I can always, the difference is just an 85 instead of an 80. So you pay a fraction in mortgage insurance at 85%. So everyone thinks if you don't have 20%, but you've debunked this many times before. If you go to any mortgage insurance company website, you can pull your own quote and type in your credit score, type in, the loan amount, but at 85 you'll see that the fee for the mortgage insurance on a monthly basis is hardly anything, like maybe 0.11% of the loan amount. So it's could be like $46. It could be $25.
Yeah.
It just depends on your price point. But it's, it's worth knowing before you write that offer, like, hey, even if it doesn't appraise, so if it's a competitive arena, because, the lower priced homes are always so competitive because more people can afford them.
Sure.
And it's like, well, I don't care. I'll pay more than it's worth because I really want to get out of the apartment and into my condo.
So that was something that we saw heavily happening in the pandemic market, right? 2020, 2021, when everything started to take off, even a little bit maybe into 2022, if I'm not mistaken. We were seeing clients or buyers that were willing to pay what we call cash over appraised value. And for a period of time, it was actually becoming quite the strategy.
Common.
How do we see this program, I guess, segueing into how do we see this program affecting the market? Do we think that it's going to drive prices up? Things have been pretty slow. This rain isn't helping. I feel like our spring market has been severely delayed. But I think from agents that I'm speaking with, there are some listings that are being prepped. There are going to be some listings coming out there.
Yeah.
This is obviously going to throw buyers back into the market. Obviously, nobody can predict the market, but we can use, history to kind of guide what this is going to do.
Yeah.
What do you see it doing?
Well, I really enjoy doing open houses every weekend because it literally can change from weekend to weekend. And part of it is a product of the interest rate. The interest rate environment is volatile and interest rates are higher, but we can always curb your payment, which the interest rate affects your payment. But you can always do the 2-1 buy down or the 1-1 buy down. That's the other thing too. You don't have a 2-1 buy down might be a little expensive to pass off on the seller, but you can also utilize the dream for the buy down.
Can you explain the 2-1 buy down just a little bit?
Right. So a 2-1 buy down is, so let's say market rates are 6.5. Well, a 2-1 buy down is in year one, you're 2% less than the original loan amount. Your payment is 2% less. And all that really is, so 6.5 to 4.5, whatever the payment is at 4.5 is what you pay in year one. In year two, you pay 5.5. So you take the difference between the payment at 6.5 and the payment at 4.5, multiply it by 12, and that's the amount that, someone pays, whether it be the seller, the realtor, the agent, the lender, or the down payment assistance can also pay it. So you use that, and it gets a little expensive when it's 2%, but if you do 1-1, because a lot of people know, well, we think rates, and the market's price this in, because, short-term rates and long-term rates are severely out of line, because the market knows the long-term rates will fall. So anyway, that's another conversation. However, a lot of people buying now are like, it doesn't matter what my payment is now, well, what my mortgage rate is now, because I'm likely to refinance. And so under that premise, you just want to make sure that the payment is where you want it to be so you're comfortable. So the temporary interest rate buy downs, lower in year one, lower in year two, or you could just do lower in year one. Say, I want a 1-0 buy down. So 1 year, 1% less. So I go from 6.5 to 5.5, and I'm okay with 5.5. And in a year, in theory, the rates will come down and I'll refinance. That's basically, and it just is different for every buyer. Sometimes they're very payment sensitive. Maybe they're paying for daycare, and that's gonna go away in a year or 2 years. So it just depends. Every buyer is different.
Yeah.
But there's tools there to help with the payments.
Yeah, every situation is different, but this is just a little insight into Carrie's brain that I think is just so magical. And the reason I like to send clients to you is because you really do take that extra time. I mean, I can't tell you how many times I've called her. She's like, on a Zoom, sorry, be off in a minute. 2 hours later, hey, just got done with the Zoom. I mean, she really does take that client care to the next level. And our goal as agents is to help you through this process so that you leave with no unanswered questions. We want you to feel very comfortable with the process. Yes, there are a lot of moving parts, but we try to educate you, and Carrie does a fabulous job on the financing side. So she didn't pay me for that. It's a little plug on my
Oh, thanks.
No, it's true. You want to be as informed as possible. And so, I'll always say to folks, I'm an information giver, right? I'll give you the information. You make the best decision for you and your family. And it's same with lending. Here are the 4 different variables that that will work for you. Choose which one that is, and you dissect it to a point that they can determine. Do I want to pay a little bit lower now and then have something later? Do we want something stable over the next 30 years? All the different programs. So it's very valuable.
I find that Zoom is a great medium. Like even this podcast is great, but if I'm sharing my screen and you see the number, but if I'm sharing the numbers over the phone, I can't gauge whether your head is about ready to explode because I'm throwing all these numbers at you or not. But on a Zoom, you can always you can see it in their face. You can also, because you can always overshare. You can go too deep into the weeds, but some people really need to be in the weeds. They want to know it all. That's fine. If you've got 2 hours, that's fine. I'll take 2 hours.
What's my payment?
Right. I want to know
that girl.
every detail.
Right.
What
some people are like, what's my payment and how much is
give me the best deal. Just show me A.
Right.
Don't show me A, B, and C. Just show me A and we'll go forward.
Right. So, but everyone is different. And so, but I prefer the Zoom because I can share my screen. They can see the numbers. And then especially the people that I meet at open houses that are already pre-approved for 5 that don't know about the program, like the one I did last weekend. She's like, oh wait, so I get 20%. So now you qualify for $650.
So let's dive into a little bit of the guidelines, right?
Mm-hmm.
So at first I think we were thinking low income, but I think they've raised, or the limits had changed. I thought it was 120. Now I hear, is it a little bit more?
Right.
So what are the guidelines? What does it take to qualify?
Yeah, you and I did a lot of equity builders last year, and that was low income limit. So you could go, and it's different per county. That limit in Contra Costa Alameda was $120,000. But this program, and so if you read through the guideline where they're asking for the funds from Congress and everything, they were saying median income, which is more, 150, and then this is a high cost county, so that 150, the median, 100% median income for the county, you get an extra 20% bump because it's an expensive, it's a high cost of living area. So that gets you to 180. So I was preparing for 180. But just last, 2 weeks ago, we had the preferred loan officers direct with CalHAFA. They announced it is the CalHAFA income limits. So the CalHAFA income limits, you go to their website, Contra Costa County is $282,000.
That's what I thought.
So a whole $100,000 more than what I was expecting.
I love how that's medium. That's middle class,
right? Well, no, but no, the CalHAFA income limits, it's 300 in San Francisco, San Mateo, and Santa Clara and Marin, and then 282 Alameda, Contra Costa, and then Solano's 215. I don't have it memorized, so don't quote me on that. But Solano was there's a lot. Solano County is very affordable especially with this program, because there was people that qualified for low income in Contra Costa, but they're like, man, we just can't find anything at 500. We can't. So, but we could go to Solano because we live in Vallejo. Well, let's get you some. Now those people that were pre-approved, now they're buying in Solano. They're just waiting on the program to roll out. Right. So it really, I believe it will move the market back to your original. I truly believe it's gonna help a lot of people, which is gonna help everyone.
Well, and then let's go back to some agents don't even know about this program, and some lenders don't know about this program, and there's some folks that have lenders from out of state. Now they're able to lend on California homes, but they may not be privy to this particular program.
Right. I'm thinking the nationwide lenders. I'll meet people at open houses and they're already approved. I'm like, great, that's good. What's your qualification? Did your lender tell you about the program? And some of them, the ones that say no, are usually lenders that are out of state, particularly because there's a lot of internet. It's a lot on the internet. Especially the millennials, which I love the millennials, okay?
It's okay, I don't always like us.
Well, but they just want what they want to know, and they'd rather go online to get it.
Well, I've had situations where I've had buyers that couldn't even tell me what their loan officer looked like. I'm a millennial that didn't know what you looked like, and how many deals did we do together, because we had never met or come face to face, even on a Zoom for, I'm embarrassed to say how long. She sent me a picture of our client signing. I'm like, is that the notary?
You get to 50. Honestly, in my 30s, I really was kind of behind. I wanted to be behind. I didn't want to be out there. I was camera shy, nothing. Then you get to your 40s and it's not as much. You hit 50 and it's like, I didn't put on makeup even for this. And I was like, I probably should have, but there's no false advertising here, but there's some level of confidence, and it's very liberating when you're like, I'll Zoom with anyone. Maybe it was pandemic ensued because we were all kind of forced to Zoom, and you just get comfortable with it. But you know what? The wrinkles, the gray hair, it's all good. That's me. And
Wear it with
deep
pride.
down, it's
Yeah.
important, and I think I'm probably more authentic and maybe more trusting because I look
Sure.
old. And, I look like
I
well,
look like I
shit,
know what I'm
someone's
doing.
mom. Like she's gonna lead me. She's not gonna lead me down the wrong path. So
Right.
yeah. Anyway,
Well, it's
That's
so much
another-
more than looks, right? As I
Yeah.
wear this bright red lipstick today.
Right.
Who cares
Easy
about...
for you to say, Jamie.
No, oh my gosh. I used to be so shy and so unconfident. Jason loves to point this out. I used to be super shy, pray for voicemails when I called somebody. I almost said answering machines. Those don't exist anymore. Let me age myself. But yeah, I used to be very different, and I'm still stepping into this, new self of mine. But
Yeah.
it happens. Now let's talk about the equity share part, because I think that's going to be the biggest. Like, what does this mean? What happens when I
Right.
go to sell?
Yeah,
There's
How
that-
long do I have to live in that? I mean,
Right.
what are those guys?
That's
That's
the
the
Somebody
real-
said this is not a good deal when
Complex.
you have to share your equity. But in the same token, it's like, well, you're not in a great position if you're going to be paying somebody else's mortgage for them by paying rent. So
Right.
definitely, let's
I
jump into
think-
that equity share.
I think also there's a lot of misinformation online when you look up like the equity share programs and things like that. You'll see like they're like, oh, don't do that. That's a bad idea. You're going to end up paying 20% later. And I'm like, that's not how it works.
Right.
It's usually not that high kind of thing. So
So
it's kind of crazy. So
let's-
what's the good information?
Right. Let's start with first of all, it's not an equity share technically. It's a shared appreciation.
Right.
So appreciation is different than equity. Your equity is the difference between what you owe and what it's worth. So remember, you're starting at a lower mortgage initially because you have the aid to purchase the home. So every month you're making a payment and you're building equity because you're paying yourself because your mortgage balance is decreasing, not increasing. So, but the shared appreciation loan is merely that. You buy it for 5, you sell it for 6, you're going to share in the appreciation. Now, last Monday, March 6th, the bulletin came out and further explained if you are low income, you only share instead of 1-to-1 on the appreciation, so 20% you share. If you take 20%, you share 20% of the appreciation. But for low income, you share 15%. So it's 75% to 1. Yeah, you did see it. So that was new, and I was like, well, that's great. And generally, if you've got lower income, you usually get a little lower interest rate. Like they give you a break on the interest rate. Just like with the CalHFA pricing, if you go to CalHFA, Google it and then go to rates. They're published every morning at 8 a.m.
And then what's the quality? If you wanted to refinance, is it possible to refinance out of that program
so
at some point?
that was another thing. Again, on the 27th, the guidelines will be live. But from the direct conference call with CalHFA, it is one time you can refinance without having to deal with paying off the second loan.
Okay.
So obviously, if you buy for 5 and you borrow 400 because you get 100, then let's say in 2 or 3 years you owe 3 whatever you owe, you can refinance one time and get the benefit of the lower payment and the lower interest rate on the 3 whatever you owe at the time. Which is a huge benefit. Now, on the equity builders that we were doing last year, 10%, which was forgiven, you couldn't refinance in that 5-year window, or you would have to pay back what you borrowed.
Because it was forgivable 20% per year, I think,
Yeah,
right?
yes.
Yeah.
So anyway, so that's a huge benefit, but you can only do it one time. You can't do it, So
what are
wisely.
some of the
so if you
other-
start at 6.5 and you get to 5 and you're like, maybe I should do it, and then rates go to 4, then you're at 5. So you just have to be okay with what you have at the time. And if the payment fits with where you're at in your life at that time, then go for it. But if not, then maybe stick it out a little bit longer. That's why the temporary buy downs are maybe something that could bridge for buyers. Go ahead.
So what
Cindy.
are some of the other rules? I think I read that like the buyers are required to live in the home, right? Like you
Correct.
can't just buy it and
Owner-occupied
rent it
only.
out or something,
Correct.
right?
Yes, it is intended for you to live there. So if you move out, then you either sell and move out, but you can't rent it out to tenants, or you have to pay off that second. I mean, that's kind of an unwritten rule. They don't really advertise it, but they do. There are terms with which you they would require the
So
payoff.
these are specifically to get new buyers into homes, not for investors to come in and pick up all the properties.
Correct.
That's awesome.
Owner occupied, yeah. There's really only 3 main rules. Well, 4 if you count the education class you have to take. And there's a separate 1-hour class just specific to the concept of the shared appreciation, because you really have to understand, you get 100, but you have to pay it back when you sell or refinance at some point in the future. And then also 20% generally of the appreciation. So you buy at 5, you sell at 6, you're going to owe 20 of the appreciation. That 100,000, the difference between what you purchased and what you sold it for, is the appreciation, not what you owe, because you're going to owe less, right? So that's your equity. So you, of that 100, in that example, 5 to 6, you get 80,000 of that yourself. So I mean, it's a good deal if
And it gets into a house a lot sooner,
depending on
right?
the person, right? Yeah,
Because the market could,
you don't have to save 20% to buy.
Yeah, and in the
giving it to
time
you.
that you are paying back that appreciation, the market, who knows what the market's going to do? And if your house is worth more, it means that you would have bought higher. So there are a lot of benefits to it as well.
Yeah.
And there's always those people that are like, well, what if it goes down in value? Well, then you don't owe any appreciation, but you do have to pay back the original loan.
Yeah.
So then it's like you will have had to have paid your mortgage down enough where you could, at that point when you sell, you would just pay it back.
Well, I like that there's classes on it so that buyers that are getting into this aren't just hearing free money and trying to go for something that they don't fully understand. I like that there's steps that they have to take so that they really know what they're getting themselves into. But overall, I think this is going to bring a lot of buyers back into the market. I know when we were doing the 10% last year, I think it brought a lot of buyers into it. You and I worked open houses where people had no idea, and we had some success stories for converting buyers to use this program. It worked out really well for them. So I think it's going to be a really great thing.
Right.
My kind of prediction is that this is going to stimulate kind of the spring market more and bring it more into the summer. We're just really slow in activity. Like I said, this weather's not helping in the Bay Area. There's storms everywhere. Things have just been kind of crazy. So I anticipate us to be a little bit delayed on what would have normally been our spring market, kind of the natural ebbs and flows. What do you guys think? Do you think?
No, I feel the same. I have clients that are kind of waiting for the spring, spring inventory.
Inventory is what we need.
Inventory.
And so it's that inventory that I'm not necessarily seeing. I'll looking in certain areas, and I'll be surprised if 1 or 2 homes come up within a certain area that my clients are looking in. And so what I'm hoping is that there is that delay, that with the weather and then this new program. It's going to start stimulating the market a bit more, but I'm also sensing that I'm still kind of usually by the beginning of March we start seeing a bit more inventory. Haven't really seen that yet, so hoping that there's just a little delay on that.
Yeah,
it's always like, when is spring break? I feel like a lot of people will use their spring break to do what they need to do, fine touch if they plan to list their home, even if they're just testing the market, right?
Yeah.
But there's staggering spring breaks for a lot of school districts, right? So, hopefully April, more people come on the market. So there's more houses for these buyers to buy.
I know I have a few listings coming up. Katrina has some, so if that's any indication, I think that there's definitely going to be some more inventory. I do think there's going to be some more buyers. So, we never pressure anybody to buy, but I do think that knowing how this program the previous program ran out, I think a lot sooner than we anticipated last year. It felt like they gave us a week deadline and said, secure your funds within the next week or 2.
That's a really good point, because that money, there's a limit
that
to
was
it.
80 that was 80 million, right? That was 80 million, and it lasted from, but it was 10%, not
10%,
20, right?
Yeah.
So it lasted from about the same time it rolled out, well, May-ish, all the way through
November.
End of November. So yeah. So 330 million. Let's hope that it lasts.
Hangs out.
I'm anticipating a year. Like, that's what Cal Happa was saying. It should be
that makes sense,
at least a year. The
6
idea
or
of the
7
$1 billion was supposed to be like a fund that just recycles itself.
Yeah.
Like, people sell, put their money back in, and then you lend it back out. Ideally, that's how it was designed and formulated to Congress. But $330 million we'll take it. We'll definitely take it.
Yeah, we're at the starting point. We're just waiting for the for the gate to.
So when
drop.
does the gate open for this program?
March 27th.
And can people start now talking to lenders about it, to you, to other lenders that offer the program? Can they start now with getting their paperwork in order with you guys, kind of thing?
Sure.
Is that
So
possible?
I mean, we obviously know the amount, 20%.
Right.
So we just kind of factored in where we're going over numbers.
Okay.
But you have to be real careful because we just don't know what the rate is going to be
Right.
on the 27th, and it's not going to publish until the 27th. But back to the first-time home buyer, the four things really. First-time home buyer, you haven't lived in a home that you've owned for 3 years. So you can own a rental property, say you inherited something, but you can't own more than 2 rental properties. That's a rule. So first-time home buyer, so if you've rented for 3 years, likely that's a check. Credit score has to be 680. If you're low income, you only have to have a 660 credit score. So you got to check your income limits per county. And then the other thing is you can't make too much income, which we talked about earlier, the 282 in contrast to Alameda. And so likely you're probably a check there. So it's going to be available to a lot of people.
Yeah, and I think now is a good time, like you said, the credit score thing. Now is a great opportunity to check in with your agent, get in touch with a lender, figure out where you stand, and figure out the things you need to do so you can be ready to secure those funds.
Right.
Are the funds available to be secured starting March 27th?
Yes, you can reserve the funds on March 27th.
So any buyers, I know I have some, any buyers that have been kind of waiting for this program to roll out are taking this time to get educated, and they will be ready. Well, some of the first ones to be ready, so I think that's going to be really
I
important.
think it's
I'm
also
excited.
great, especially for new buyers. They go into the lending and they don't realize how much paperwork is needed for the lenders. They don't realize they have to have their tax returns or their pay stubs for a couple weeks. And with the digital age, like most people don't even get a pay stub anymore. They're like, oh, I got to figure out my login. I forgot my password.
Right.
So, having that time now to go ahead and start getting those things together, to contact the lender and say, like, what will I need for this program? What do I need to get ready, kind of thing.
Yeah.
Just gets them ahead of the game so they can get in and get those funds secured for them quicker before they do run out, kind of thing.
And before this, potentially has the opportunity to change the market, to raise housing prices. There could be a lot of
Absolutely.
competition back in the game. If we do get a rise in inventory, that would hopefully help combat it. But if we don't, there could be a lot of buyers per property. Like you said, buyers are going towards the homes they can afford, and that's usually the under 650, maybe even under 600 range. Those are going to be probably highly competitive. So it's definitely, I would say, time is of the essence in, an appropriate way without trying to force anybody to get into the market. I do
Yeah.
think it's to their advantage to take, or I think it's in their benefit to take advantage of this sooner than later.
Absolutely.
Yeah.
What's your phone number, Carrie, if somebody's interested and wants to contact you about the program?
So
We'll link all your information to
Yeah,
it.
yeah. 925-433-0776 is my office line.
Okay.
So yeah, you can call me anytime. I'm happy, and really, it's about education. Even if it's not for you, it might be for someone else.
Well, or even for just a path. Because
Right.
I'll always say, somebody's like, oh, I don't know about, it seems like it's such a big step to start transferring documents over, and people want to review my financials. It seems like it's kind of almost a mental block sometimes for some folks. And I say, listen, it comes at no cost to you
Right.
to have a lender just to review your information. Just review it. See what you could be capable for. Sometimes people don't feel like they can purchase a home.
Yeah,
And they realize all the programs that are out there. They're like, how come I didn't set a course or a path for myself? So you can help someone who may not be qualified right now, but put them on a course where they could be in 6 months from
Right.
now or a year from now.
We can always help with credit. We can always, so there's definitely, there should be no barriers for entry, especially with this, because down payment is usually the big hot button. That's the hardest thing to do, is save. It's hard to save in this area. Everything
The
is
cost of living
kids
is high.
and
Have you been to the
everything.
grocery store lately?
Yeah.
It's cheaper to go out to dinner with
Eggs,
your family
man.
of 4 than it is to buy the.
True.
Yeah, it's
But-
insane.
But where there's a will, there's a way, and it might not be now, but it might be in a year.
Sure.
So you never know.
Just having a path,
Mhm.
right? You don't want to get a year out and
So
then go,
true.
now I'll start looking at it, when you could have done that a year ago and started making the small steps to get you to where you
And
need
a lot
to
of
be.
people are like, there's no way. Look at the price of these houses. There is absolutely no way. And then you really go into the numbers and they're like, oh my gosh.
That's what I'm paying
it's
for rent.
Right.
Yeah.
Right. So, yeah, it's exciting. It's an exciting time.
It is an exciting time. How are we doing on time, guys?
Speaking of time,
Speaking of time.
I know.
We
have
have
talked
talked
about
about
this
this
wine.
wine. We're a wine about the bay kind of group.
Wine
And
about
so,
real estate.
talk about.
and so
Okay,
so
everybody,
Carrie's
let's all
you're
drink
not
the Kool-Aid.
you're not a big wine drinker, so this is just kind of
I
an
know, right?
introductory red from. It's the same one we had our last podcast, which is my favorite.
Oh
it's
yeah,
bocce.
we usually start by talking about wine. So today it's bocce, right?
Yeah, it was what we had the last. It's one of my
It's a
favorites.
crowd favorite. It's goes very well with. It's a social wine, so
This
you
is
can
good.
pair it with things, but it's a very good social wine to just sip and enjoy,
down, yeah.
or just down. You can drink it like water as well.
I was like, just a smidge. I don't want that much. Excuse me.
I said I wasn't drinking, and everybody gave me crap today. So love that for me. Can't make yourself better in this.
That's cute. No,
okay.
not with us.
Well,
So it's a little dicey when you're live and you got to drink. You know what I mean? Like,
oh yeah. Oh, usually. Oh, I get better. I get better with every sip.
You're doing great on time if you want to just discuss the financial
Yeah.
thing.
So I'm gonna let Carrie take
Oh.
that. What's been in the headlines this week?
The
What
big
is
headline
everybody?
is about the bank and the bailout with Silicon Valley Bank.
Yeah.
And there's some
It's
fear.
not a bailout
Oh, okay.
necessarily. So I think the problem is you just can't believe everything you read.
Yeah.
Okay,
Right.
so if you're worried as a person, about your deposits at a bank, I wouldn't worry. I mean, you have $250,000 in FDIC insurance per bank per account. So it was the companies that, had more than that. How did they not know what the limits were, number one? But truthfully, all the government did was say, we're going to make the depositors whole. We're not going to bail out. So you can't use the word bailout because the investors, like the stockholders lost, the bondholders lost. Like a lot of people, the CEO who should have lost. See, I should be careful with the.
That's for
but-
a podcast after dark.
Yeah, right.
But what people, what I think our listeners are going to be concerned with is how is this going to impact my loan?
Right.
You banks, how I'm purchasing. Should I move forward with a purchase? Is my money protected where it is right now as I'm saving for the down payment? I think that could be a concern for some.
I mean, by and large, the banking sector is going to be not bailed out, but they're going to be, your deposits are not at risk. So I wouldn't worry about that. And I wouldn't go pulling my money from a smaller bank to a bigger bank.
Putting it in the mattress. You're
Right.
not recommending a little Ziploc bag
Yeah.
and under the pillow.
Right. No, I would not recommend that because, then when you go to buy a house and you're like, well, where's your down payment? I'm looking at your bank account, your balance
Mattress.
is, I have it in cash. Oh, Lord.
Right,
But yeah,
right.
so, but the banks are fine. So everything's rebounded. Over the weekend, it got a little, and you're going to hear a lot, depending on who you listen to, different slants, right? I feel like it's over politicized to a certain degree. However, fundamentally, the depositors were made whole first thing Monday morning. They announced it Sunday because early in the weekend, Janet Yellen was like, where there will be no bailout. Well, you can't have a run on all the banks or that's a real problem. But so Silicon Valley Bank and Signature Bank, and then yesterday, Monday, was a little crazy. They had to halt trading for certain regional banks. First Republic Bank was one of them, who's very well known, especially in our area. But their stock really took a hit yesterday. But then this morning it opened and it was fine. So is the contagion still there or not? We'll have to see. But overall, banking, your deposits are safe.
Yeah.
Up to $250,000. If you're over that, then maybe move some.
Maybe you need to buy a house.
to-
Maybe you need
Yeah,
to buy
right, for
investment
sure,
property.
There you go. Make
I
it
can
work
think
for
there's
you.
probably some people who sold their home who are sitting on a lot of liquidity to buy and haven't found the right thing to buy. So for those people, definitely have it maybe in a few banks. So it's covered by the FDIC insurance.
Yeah.
But I'm not worried. I'm not worried.
Okay.
But
Good. If you're not
So,
worried, neither are we.
yeah.
Right,
well-
neither am I. Carrie says it's fine. It's
No.
fine.
It's
I
fine.
mean-
You're fine. Go put all your money in the bank.
yeah. Well,
Up to
get
you,
it out
Vicky.
of your mattress.
Yeah,
Do that.
definitely get it out of the
Maybe,
mattress.
so one of the published guidelines for cash deposits is less than 50% of your gross. We're not going to ask about. That's a Freddie Mac guideline. It says right there in your automated approval, any deposit greater than $5,220. So if you made, $10,440, You know, if that was your gross income for the month, it'll say right there, any deposit more than that has to be verified. So don't deposit more cash than is 50% of your gross.
Sure.
That's my advice for the pod.
Okay, that's a good one. That's a good piece of advice.
So anyway,
Well, I think that about wraps us up for today. We gave out a lot of information. Thank you so much for being
Yeah.
here. You know that we love
It
to
was
just
fun.
And then
brain.
Homebridge. Okay, so you're with Homebridge Financial, but you're
3 weeks.
shifting named.
Right, very
company.
exciting. So, so our headquarters at Homebridge is in New Jersey. Well, we were acquired by a more local mortgage company, CMG Mortgage. So
Okay.
CMG purchased Homebridge's retail. Homebridge Wholesale is still operating, but that's exciting for me because headquarters are closer, and it's gonna more product offerings.
We love that.
Yeah, construction to perm, which we didn't do a lot of. They've got more jumbo offerings.
Okay,
So
so it's a
2
great
is better
fit.
than 1. We
Yeah.
just kind of merged, and our cultures are very similar. So we're not I'm excited for the move personally. But,
It won't, and
yeah.
it won't really affect anybody except for a name change. And
Correct. It's just
Yeah,
a name
and
change.
more programs and more
Same.
programs
and
that
more
are available.
options and opportunities for you.
Right.
Yeah.
So we're excited for you, and we really want to thank you for being here. We're
Yeah.
so glad to have Cindy on her
Yeah.
first podcast. Cindy Two Legs
Thanks.
over there.
Yeah. Yay, too late.
Who's recovering well?
Who's recovering well.
Yes. Yeah.
You did great. Yeah, we're so excited to have everybody. So thank you all for being here. I'm glad to have this nice panel of ladies here on
Definitely.
this beautiful rainy day. But we hope you tune in to next week's episode. I think next couple weeks episode. This will be released soon, and you can find us on Instagram at Maddox Podcast. I think. Correct me. At the Maddox
Maddox
Podcast. Yeah, I should really have this written down.
YouTube, MaddoxPodcast.com.
YouTube, MaddoxPodcast.com. You can find us at MaddoxRealEstate.com. You can find me at Realtor.Jamie on Instagram. You can find Carrie by her number she just gave you.
Katrina Pryor.
At
Just
Katrina
look me
Pryor.
up. I'm in the book.
I'm in the book. And then do you have an Instagram?
I do, but
Real estate? We're going to get you on
Yeah,
that.
I've gotta
Well,
get
stay
on
tuned. We'll link everything in the
That
description.
would be a good podcast, like how to set up your
Oh.
socials.
Yeah.
Yeah, you can.
You need a social
guide you
media
through that.
like guru to come in here and lay it down.
We do. It's definitely not me, but we do need somebody to come in here. So maybe
Just a thought.
future
Definitely.
episodes we'll teach you how to do all the tech stuff. But thank you for tuning in today, and we
Thank
really
you.
appreciate your time listening. And we're gonna get off camera and drink the rest of this wine.
Yep.
Cheers.
So,
Thank you.
Bye, everybody.
Thanks, everyone. Yeah, should